welcome to the latest episode of FTI Treasury Talks, Conversations with Experts. I am Shane O'Keefe, Head of Innovation here at FTI, and today we're going to talk about FX volatility and how corporates manage that and what impacts it has on them. Currently, the FX environment is quite volatile at the moment, so we thought it would be a good time to take an in-depth look at how we can manage this. I'm delighted to be joined by Barry Callaghan here, who's our Senior Front Office Manager in FTI. How are you, Barry?
Pleasure to be here, Shane. Thanks for having me. As you said, it's a good time to have this quick chat as the FX, the volatility in the markets is pretty unpredictable at the moment. So yeah, it's great to see.
Yeah, and we've seen rates floating around the place quite a lot.
Yeah, so there's a few main drivers really at the moment. So we're looking at inflationary cycles in relation to driving cash flows. We're looking at geopolitical tensions, be that in the Middle East or friction between US and Iran, and then we're looking at divergence with the central banks in relation to when you have the likes of the ECB, the Fed or the Bank of England moving in different directions, that can have a significant impact on FX volatility.
Yeah, I can imagine. All right. So is it important to have a strong framework in place so that you're more proactive instead of reactive?
Yeah, that's another good point. Yeah, absolutely. At the moment, so in the past, our clients would have been a lot more reactive to this, but really at the moment you need to be on the ball. You need to be much more proactive in relation to a framework. You need to have a good robust FX plan in place. And I would split that out into 3 or 4 different subsections if you want. First, you need to identify your exposures, be them transactional, be them balance sheet exposures, be them economic exposures. You need to break them down and have a look under the hood and see what's going on. Next, you need to then measure really and prioritize your exposures, and there's different tools that you can use for that. You can look, you get a sensitivity analysis, your VAR, your value at risk, or one of the common ones you're doing stress testing in relation to if you're you can see you keep looking out into the future and seeing, well, if this moves by that or if this depreciates by that, and then you can go from there and you can put a good framework in place.
So from that and getting it as the data you get is quite important to make sure that it's accurate as well before you even start doing
absolutely. Everything's data driven, but the data accuracy is key. Really, data accuracy is key. And then that leads on to then you defining your FX exposures and the tools you want to use for that, and your risk appetite. We're seeing at the moment a lot of clients of ours using maybe possibly forwards, which is it's certainly down the line, but there's other options which gives you a bit more flexibility. Then you have your layered hedging where you can layer it on certain sections, and then you have your natural hedging, which is offsetting your ins and your outs and stuff like that. So
I'm assuming we'd start with our natural hedging, is it? See what's natural. And you could have your forwards out for a portion of it, and then if you really want to, you could have your option to get up the last little bit.
Absolutely. Well, what you're seeing at the moment is that it's not one size fits all, in that you can have an absolute you can have a mix of both, or you can have a mix. You can have a mix of the forwards and the options. Where as I said, the forward gives you more certainty at a certain time, where the options give you a bit of flexibility over time. But then you can come into your layered and your natural. You can have it. You can have a portion of everything. So
and that helps them as well with your hedge effectiveness.
Absolutely. So
layers
and then. Lastly, then you're down to your execution, and that's where myself and my team come in. So we're with our clients, we have the dedicated centralized front office. So everything comes through us, and you can consolidate and coordinate your hedging strategy. If it's all concentrated at one place, it's much easier to manage.
Yeah. So it gives you control over
absolutely.
how the organization does there.
Absolutely.
What are the main how do we see our clients managing the FX volatility?
Well,
mainly?
that's a good point. So there is, I suppose, it's threefold. I see a lot of balance sheet hedging.
Yeah.
Which kind of reduces your FX, your FX dominated exposures by offsetting, with your assets and your liabilities. You have cash flow hedging, which looks, into your future cash flows, and you can hedge up to, you can hedge on a monthly basis up to, up to 12 months, 18 months out, which does help you with, unexpected market movements, I suppose, like that.
Yeah.
And then we have, and I know it's dear to your heart, is the intercompany netting.
True.
Which gives you, which is a great tool, which we use extensively here in FTI. It gives, centralized visibility over, over entities' flows. You have one entity offsetting against another entity, and it drastically reduces your FX volume. And we look at our figures we can look at netting figures ourselves on a monthly or quarterly basis, and you can see the savings are there.
Yeah, because I'm assuming if you're running a intercompany netting cycle in parallel with a balance sheet hedging program, you're minimizing the amount of FX deals you have to do on your balance sheet hedging, because you've cleared all your intercompany balance sheet items. So
absolutely. You can so you're instead of, you have different entities, Australia has to pay the US or something like that, and they're mixed matching across internally. Everything is centralized down to us, and then we will have one, you have one Aussie dollar FX and one Euro FX. So not only are you getting, plus if you're centralizing, you're getting, you're competitively bidding, you're getting better pricing. So it works out overall, yeah.
And because I think, is it around the average, like for what we see in our clients, is like, if you do a good intercompany netting cycle, you're saving your cost of hedging by like 30 or 40%.
And sometimes more, absolutely. It can drastically reduce, So and it's and the intercompany netting side of things, the entities love it. So in relation to, if you have a monthly cycle, everything just feeds down. They love their files, stuff like that. So yeah, absolutely.
I was actually working with another one of our colleagues there, Lisa, today, and one of our clients settles like 12,000 something invoices through every netting cycle, and it's done every couple of weeks. But just on that alone,
Oh yeah, they say the savings they're huge. Absolutely, yeah. So no, it's so as you said, just coming back to initially, you're looking at your balance sheet hedging, you're looking at your cash flow hedging, and and again, you're looking at running intercompany netting cycles. Be it, we have clients that once a month, twice a month. We have two particular clients that have numerous across the course of the month. So, one finish and we go again. So it just cleans up everything as the course of the month. Yeah.
So it's important probably to have the right structure in place as well, like to have an in-house bank structure or a centralized treasury or FX trading center.
Absolutely.
It gives you the control.
Well, it gives you the coordination, the control. Absolutely. If everything, so you don't have, it reduces the amount of voices, shall we say? You know what I mean. So if you have one point of contact in relation to a dedicated, front office and back office, and that massively helps. Yeah.
And then it's reducing your cost of hedging as well.
Absolutely. Yeah. So yeah.
Is there, what are the other things we need to think about in strategy wise?
Well, that's a good point. So we've already spoken about centralized FX execution, which improves, as I said, massively improves control and pricing, plus also compliance. You know what I mean? So as I said, if you've one dedicated area doing it, then you haven't, the entity's gone off, and a lot of time you'd see if entities are companies aren't doing it, then you have entities just working alone, which can cause issues down the line in relation, different accounting treatments, and you can have entities then if they're internal disputes and stuff like that. Another huge thing is forecasts, and as you well know, good hedging starts with good forecasts. So if you don't, if it's good data in, it's good data out, and if it's, as I said, if it's bad in, it's going to be bad out. So it's all about it. That's the integral part of what we do in relation to communication and good forecasting. So,
and on that forecasting thing, someone needs to be responsible for that. Is it important to get clear guidance on like, to see when it is right, or if something's well off, you go to X to make sure.
Absolutely, you'll do your actual versus forecast. You do a variance analysis. So like it can take time to build, but you know what I mean. And sometimes with different companies and their subsidiaries, they come out, there may be a bit of pushback on it. But if you build it over a 6 to 10 to 12 month period, the benefits are huge. So absolutely, yeah.
And like there seems to be an awful lot of data gathering. Is it very time consuming to get all that information together?
In relation to the forecasting?
No, not even forecasting, but like your balance sheet hedging. I'm assuming you're getting all the balance sheets for all the different.
It's no. There's we can consolidate it down in relation to, and we can execute off one. So if you have a client or an entity or a client, they work very well in relation to getting all the information from subsidiaries into, maybe if part of the US, Treasury is based in the US, they can consolidate all the information, feed it into us, and we'll go ahead and execute. Absolutely. So,
and I'm thinking now from my head of innovation head here, but like the automation and RPA functions there, is it important to get automatic feeds from, let's say, all the ERP systems into whatever tool you're using to consolidate that information, so that you have live data instead of like, not previously people were sending it in by email or,
spreadsheet.
Yeah.
And that's, yeah.
And like, by the time it's all consolidated, it's 3 or 4
days. Yeah, no, the RPA has been a massive addition. So, if you're getting up to date real time data, that's a huge boon for being able to make the correct decisions at the right times. Yeah. So, like on top of that, then you also you can run a scenario analysis. You can look down and go, maybe I'm just thinking, what if the euro dollar moves by 5%, or I don't know, maybe the Turkish lira or something like that depreciates by 10%. You can look going, what's going to happen here, and so you're prepared for shocks in relation to that. So, and then fine. Well, number one would be, then essentially number one, but you can have a layered hedging strategy like we spoke about before, and that you can just distribute your hedges and your stuff over time. So. Yeah, there's different ways and means about doing things. You know what I mean? It's not to say, as I said before, one size fits all, but it can be a mix and match of both. Yeah, absolutely.
Yeah, like back to my head of innovation hat. Like I always see that we should automate and RPA where possible, where it's a repetitive task. Where it's a very complex task, where you're more involved. We're trying to put in a standard process around it, make sure we follow the same steps every time. And like, if we can do that, it does free up then the staff to more do the strategic, where it is adding the whole
100%. So if you're getting that, as opposed in the past, if you're getting the data, delivered in the morning, so we're sourcing it, and then we're sitting down, we're looking at our balance sheet, we're looking at our cash flows, you're looking at your forecasts. It gives you time, and it gives my team time to look into the weeds a bit more, as opposed to spending time and sourcing everything else. Yeah. Whereas you can make better decisions. Absolutely, yeah, 100%. Yeah, but it does, like, there's forecasting, coordination, data integrity, communication. In relation to making the right decisions from an FX point of view. They're the top tier things you need to be looking at.
Like one final question I have is like, do we see most of our clients using just standard vanilla FX forwards, or do you see a lot of them using options or stuff like that?
Well, there's as we discussed earlier, there's a lot in relation to hedging, in relation to your cash flow hedging. Maturity would be forwards, but we're seeing more and more of people using, or clients using options because of the flexibility in that involved and stuff like that. So it can be a mix and match of both, to be perfectly honest. If not, you have your general, your forwards and your swaps and stuff like that. But it's
like, I'm assuming forwards are just easier from an accounting point of
view. From an accounting point of view, and from a pricing point of view and stuff like that, and from to be quite honest, from an execution point of view, absolutely. Yeah.
Look, Barry, thanks for your time today. I think that covers speed.
Yeah, absolutely.
What FX volatility is.
Thanks for having me. Yeah, no, I would just to finish up. I mean, we did it's always good to have a solid FX policy, in place. In the past, I would have said you would review that possibly annually, but at the moment, I think you need to be looking at that on a regular basis. So you know what I mean. I wouldn't say quarterly, but at least on a 6-monthly basis, you need to be. So and then it's all down to then good communication, coordination from top down, really. So
like a summary would be like, have a strong framework in place first.
Yeah.
Then understand where all your FX is coming from.
Yep.
Integrate as much as possible.
Absolutely.
And then, centralize everything from an execution point of view, where then you can do things in most cost efficient.
Absolutely. Making better decisions and reviewing a lot more frequently than possibly you did before. So
yeah. Look, thanks for joining us on this Treasury Talk about FX volatility. If you need any more information in relation to this, please look at our website, ftitreasury.com. And thanks, we'll talk to you again soon. Bye.